All right. Hey, trust you are doing well. Hope you have had a great week. I just wanted to kind of do a quick video update, kind of share with what we're looking at, what we're seeing, what's taking place in the market. It's been an interesting couple of weeks. Definitely, you see about 2 weeks back, we had the jobs report came in with job creation, about 115,000 jobs, again, higher than what people expected. So it's reflecting that the underlying economy is doing a bit stronger than some of the perilous, indications that people were looking to or talking about. And so it shows that the, underlying job production is still there. It shows that even though there are definite weaknesses in the economy, that overall the economy is still chugging forward, which again has been quite surprising for many people. Looking, if you go back to 22 and you look at the massive interest rate increase accelerations that the Fed did, and we saw how the economy has been resilient and strong. The biggest thing that's been kind of the game changer is this past week's inflation data that came in. CPI came in at 3.8, up from 3.6, and then core inflation came in up 2.8 from 2.6. And again, it had previously been moderating, right? Which was a positive thing. And then now the effects of, the war in Iran, the accelerated gas prices, the accelerated oil prices, all this is coming to roost. You see, fuel oil prices impacting things up 50%, gasoline impact is up 28% embedded in those inflation numbers. So these are real things that are not going to be easily resolved. The other reality of that is then the bond market then responded to that as well in saying that, okay, inflation is here, interest rates are higher for longer. The sell-off in 10-year and 30-year treasuries took place. Presently the 10-year treasury is about 4.6%. So in just roughly, 5 weeks, it's gone up, 60 basis points, which that's huge. So what does that mean? It's what we've been saying all the while is that, interest rates are higher for longer. And then now we see that the new Fed chair coming in, Warsh, he's going to have a difficult spot for sure because, again, like there's a desire for interest rates to be lower. There's not really the data to support it when you've got inflation creeping up. And unfortunately, the regime in Iran, they are radical, ideologically driven. They would rather burn their people down and their country down than give up their political ideological regime. And so, what was proposed to be like, hey, we're going to be in and out in a few weeks is not really the case. And that's also where people are seeing, like, even if this thing was resolved in a week, it's still not going to resolve all the gas and fuel and oil problems that are embedded now as a result of this, stuff. I'm not saying that it didn't have to be with them as, radicals getting a hold of nuclear capacity or whatnot. But again, it surely is not good timing for our country where, again, you look back into, say, commercial real estate, they've been hit and hammered in a number of ways because of interest rates, because of inflation, because of the increases in insurance costs. Those things are all real. And then now, just as things are moderating and things are starting to pick up in terms of transaction volume, you got interest rates, really kind of skyrocketing again, taking a 60-point jump on long term. And then undoubtedly, the Fed's going to have to take a position of, from declining to neutral or then to actually raise rates to offset inflation, depending on how embedded it becomes, how long it's sticking. And so, the most prayerful thing that you could look at is what's the resolution to the Iran scenario? Can that get resolved, and does it get resolved, here in the near term? If it does, that's going to be helpful. If it doesn't, it's really going to present a difficult reality. Now, that being said, you got to look at also, like we talked about before, some of the opportunities that are coming into the marketplace. There still is distressed opportunities coming to the marketplace. We looked at a property that is probably 50% of ARV. Just about 2 weeks ago, we were up checking on some progress on some existing properties, and that's the case. There's another little small property locally here that, again, same story, 50% of ARV. So that really is something, and we'll dive into this into a future discussion. But again, that's where you can really offset your risk. Right now, there's an interest rate risk. Interest rates could go up, right? Because again, they already are. And if there's not a taming of that with respect to the oil market, the Iran situation, there's a high probability you're going to see interest rates higher, not lower. And so then you've got people who have been talking about, and you see some of this online, buying a deal, and it's going to be a great deal, and it's a value add, and interest rates are going down. And it's like, well, interest rates aren't going down. But when you look at some of this distress stuff that's going on, you're buying at 50, 60%, 40% off from the ARV, that's your real play. And that's an ARV in today's dollars. I seen one guy talking about how I got this great deal at 70,000 a door, and other properties are trading at 140 to 300, talking about 70s vintage product in a certain market. It's like, there's no 70s vintage product trading at that price. I mean, the guy's just not being, forthright. So, but anyway, this being said, we're going to dive into that, talk about that, break that down in the next episode about some of the distressed opportunities. But you really want to pay attention, because again, we've been saying this for the last 18 months, and this is even more so the case now. Interest rates are going to stay there, be elevated longer. We're going to be in a more elevated season, and we have to operate accordingly. So have a blessed and victorious week, for this is the week God has ordained for you.